Hello, fellow investors, and welcome back to our channel. Whether you're a newbie or just looking to brush up on the fundamentals, you're in the right place. Today, we're embarking on a journey into the core concepts of the stock market. If you haven't already, hit that subscribe button and ring the notification bell so you won't miss out on any of our upcoming videos. Let's dive in. 1. What is the stock market? Let's start at the very beginning. What exactly is the stock market? Simply put, it's a marketplace where individuals and institutions buy and sell shares of publicly listed companies. These shares represent ownership in those companies. The stock market is where investors come to trade and potentially profit from the rise in the value of these shares. 2. Importance of stocks. Why invest in stocks? Well, stocks have historically provided the potential for higher returns compared to other investment options like bonds or savings accounts. But remember, along with potential reward comes risk. Prices can be volatile, and there's no guarantee of profit. 3. How stock prices move. Ever wonder how stock prices move? It's influenced by supply and demand. If more people want to buy a stock, demand, its price tends to go up. If more people want to sell, supply, the price tends to drop. This dynamic creates the constantly changing prices you see in the stock market. 4. Bull and bear markets. Two terms you'll often hear are bull market and bear market. A bull market is characterized by rising stock prices and general optimism, while a bear market sees declining prices and pessimism. These market cycles are a natural part of investing. 5. Stock exchanges. Stocks are traded on stock exchanges, like the NSE and BSE. These exchanges provide a platform for buyers and sellers to interact. Keep in mind that not all companies are listed on the same exchange. 6. IPOs and secondary offerings. Companies can go public through an initial public offering, IPO, where they offer shares to the public for the first time. Later on, they might conduct secondary offerings to raise more capital. These events can impact stock prices and are important to watch for. 7. Market indexes. Market indexes, like the Nifty and Sensex, Bank Nifty, track the performance of a specific group of banking stocks. They give you an idea of how the overall market or a particular sector is performing. 8. Diversification. Diversification is a crucial principle. It involves spreading your investments across different stocks and asset classes. This helps reduce risk. If one investment underperforms, others might make up for it. 9. Basic investment strategies. There are various investment strategies, from long-term investing to day trading. Long-term investors focus on buying and holding stocks for extended periods, while day traders make quick trades within the same day. Choose a strategy that aligns with your goals and risk tolerance. 10. Fundamental and technical analysis. Investors use two main types of analysis. Fundamental analysis involves evaluating a company's financials, management, and industry trends. Technical analysis, on the other hand, Studies historical stock price patterns and trading volume to predict future price movements. 11. Risk management. Understanding and managing risk is vital. Never invest more than you can afford to lose. Consider setting up an emergency fund before diving into the stock market. And remember, patience is key. Don't let short-term fluctuations derail your long-term goals. Let's go through with important ratios that investors use to analyze stocks and make informed decisions. Price to earnings, PE, ratio. Formula: PE ratio equals stock price, earnings per share, EPS. Example: Company ABC has a stock price of 50 and an EPS of 5. The P/E ratio would be calculated as follows. P/E ratio equals 50, 5 equals 10. Interpretation: a P/E ratio of 10 suggests that investors are willing to pay 10 for every one of earnings. This could indicate an undervalued stock compared to the industry average. Price to book, PB, ratio. Formula: PB ratio equals stock price, book value per share. Example: Company XYZ has a stock price of 60 and a book value per share of 20. The PB ratio would be calculated as follows. PB ratio equals 60, 20 equals 3. Interpretation: a PB ratio of 3 suggests that investors are paying 3 times the book value of the company's assets. This ratio can help evaluate whether a stock is trading at a reasonable valuation relative to its assets. Dividend yield. Formula: dividend yield equals annual dividend per share, stock price, 100. Example: Company DEF pays an annual dividend of 2 per share, and its stock price is 40. The dividend yield would be calculated as follows. Dividend yield equals 2, 40, 100 equals 5%. Interpretation: a dividend yield of 5% indicates that for every 40 invested in the stock, an investor would receive 2 in annual dividends. Debt to equity ratio. Formula: debt to equity ratio equals total debt, shareholders' equity. Example: Company GHI has a total debt of 1 million and shareholders' equity of 2 million. The debt to equity ratio would be calculated as follows. Debt to equity ratio equals 1 million, 2 million equals 0.5. Interpretation: a debt to equity ratio of 0.5 suggests that the company has 0.50 of debt for every 1 of equity. This ratio helps assess a company's financial leverage and risk. Return on equity, ROE. Formula: ROE equals net income, shareholders' equity, 100. Example: Company JKL has a net income of 500,000 and shareholders' equity of 2 million. The ROE would be calculated as follows. ROE equals 500,000, 2 million, 100 equals 25%. Interpretation: an ROE of 25% indicates that for every 1 of equity, the company generated 0.25 in net income. This ratio measures the company's profitability relative to its equity base. Congratulations! You've just covered the basic fundamentals of the stock market. Remember, investing is a continuous learning process. As you continue on this journey, stay curious, stay informed, and never stop seeking knowledge. Thanks for joining us today. If you enjoyed this video and found it helpful, don't forget to give it a thumbs up and share it with your fellow aspiring investors. Leave a comment below if you have any questions or if there's a specific topic you'd like us to cover next. Until then, happy investing, and we'll catch you in the next video.